In this video, we want to talk about the difference between having a taxable retirement account versus a tax-free retirement account. And in today's environment, most people work for companies that offer a 401k. Certainly the larger companies do, and many smaller companies as well. And everybody's being encouraged to put money into a 401k because you put the money in pre-tax and you don't have to pay tax on it until you begin to take it out of retirement. But many people underestimate what it takes to create an account that has never been taxed and then will be taxed upon distribution in comparison to an account that might never be taxed, such as a Roth IRA or a Roth 401k. So we're going to contrast the difference in the lump sum accounts. We're not going to get too deep into the tax issues right now, but just want to show you a little bit of an illustration of the difference between the two accounts in terms of how much money it takes. So what you're seeing on the screen, this first set of numbers is we're taking a 30-year period of time that you're going to retire. In both cases, we're going to talk about retiring over a 30-year period of time, retiring at 65 and living till 95. I know many people can't envision living to 95, but many Americans are doing that today, and we have to consider that we're living longer. We're going to apply a 6% earnings rate. You may be able to get higher or maybe less, but we're using that as the example. And we're looking at an accumulation of $428,500 in your retirement account. And so we're looking at pulling out each year just the interest, the 6%. And in this particular case, on this account, that amounts to $25,710. We're going to take a withdrawal of all the interest on this account each and every year. And at 6%, the amount of interest is $25,710. The tax on $25,710 in a 30% tax bracket, and by the way, the 30% tax bracket is a combination of state and federal. We're assuming you're making enough income to be in that tax bracket, is a little over $7,700. That leaves a net take-home amount of $18,000, which is about $1,500 a month. So an account of $428,500 earning 6% generates a net income after tax of about $18,000 per year. Now let's contrast that with a tax-free account, an account that there will not be any taxes during the distribution phase of that process. And that $300,000 account, we're going to pull $18,000 a year out, and because there is no tax, that is our net. So what is the value here? What is the lesson? 43% more money in a taxable account to generate the same amount of income from a tax-free account. Now, assuming that we could earn the same in either account, what could you do with an extra $128,500? Meaning, in the tax-free account, if you could have had that same earnings rate, you'd have $128,500 more. So let's take a look at what that would look like. If we go back to this other account and assume that there is no tax, we'd have, instead of $18,000 of net income, we'd have $25,710. So we'd go from $1,500 a month to a little over $2,000 a month. That's a 25% increase in our income while we're retired. So what we're trying to help people understand is that while it's nice to get a deduction up front, ultimately having as much income in a tax-free account is where you should be focusing on building wealth. Anything that will contribute to your income in the future that will not be subject to taxation may be the most important financial decisions that you make.